Master your money, free your future. Welcome to Budget for Life. My name's Jeremy, not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. I want to dive deeper into, line by line, the true cash floor of GameStop. What portion of their market cap is represented by cash? And then how do we think about that on a per share basis? How do we value then the market cap of the enterprise value net of their cash, particularly in light of their convertibles and the coming dilutions? We're going to get into it. Hopefully, it makes a lot of sense because there's still been a little bit of confusion on the internet about this topic. Before I get into it, just want to say thank you for all that have joined the sub club. Okay, we're on a march to 2525, the inaugural year of the Halo Wars, the Human Covenant War, I should say. Thank you for the likes, the comments, the engagement. Thank you to those who join the channel as fans and as friends. All the earnings of this channel do go to DRS Book GME shares, so I appreciate the support. So let's talk about the cash flow of GameStop, whether you're talking about dilution or whether you're talking about debt related to the convertible bonds. So do they pay these back in cash or do they pay these back with shares and therefore dilute the float? How do we go about thinking about it? Well, what do we know right now? Right now, literally right now, GameStop, as far as their most recent reported numbers, had 9.2 billion in cash and in Bitcoin. And right now, they have 447 million shares. So right now, they have $20.62 worth of cash represented in their company. Now let's talk about the coming dilutions, and then we'll look at debt, and then we'll talk about the valuation of the company. So when you talk about, well, but they're going to have to owe some money on, like they have to pay some of that money back. Well, first let's think about what if they don't, right? And when do those dilutions happen? 1.5 billion worth of dilution happens in April of 2030, and then 2.7 happens in June of 2032. In this exercise, I'm not even factoring in the warrants, but if you wanted to factor in the warrants, that would only reflect even more bullishly on the value proposition that is GameStop right now, because the warrants only convert if GameStop's trading at over $32 a share. If they're able to raise 1.9 billion in cash at a $32 per share valuation, well, that is obviously going to raise the floor faster when their share price right now is going for $21 a share. Right? So if you place a 50% premium on new cash they're able to generate, that is going to raise their cash floor that much faster. But let's leave that out. Let's say they're unable to convert those warrants for the foreseeable future. Just from the rest of this year, what type of cash are they going to generate? Approximately $200 million of interest and gains and $350 million of income from operations. That's income net of SG&A, net of cost of sales. I'm going to get into my earnings projections in a coming video, but you could project your own dollars if you want. I'm going very conservative right now. In these projections, I'm just assuming they cap out at that 500 million per year earnings from operations. In reality, this will in all likelihood continue to grow at least at a 10% rate, right? If you track with my valuation for the retail business, you're looking at a 10.05% growth rate on the top line, which presumably would not coincide with an exact proportional increase in SG&A, right? Likely they would be able to grow top line faster than the cost of SG&A would increase. And so, more accurately, you would look at these numbers for each year actually going up as far as income from operations go. But I left it here to be simple because also you could argue that the interest is going to come down, right? We know that rates probably will come down, and so that could lower interest income. However, that could also increase Bitcoin income. So that's why I don't model this going down. One, because if rates do come down aggressively, GameStop likely will make more gains on their Bitcoin position. And two, their cash position is growing, right? So their cash floor each year that they generate more cash, cash from interest and gains, cash net income from operations, it is growing their cash floor correspondingly each year. And obviously, the more cash you have, the more money you could then make with that cash. And so you could model this column actually increasing more aggressively. You could also model this column increasing more aggressively. But we actually know with a pretty high clarity that the income from operations, unless something craters, is going to be about $350 million just in Q3 and Q4 put together. And again, I'll show that in a future video. If you wanted to pick a different number, fine. But again, then you can model it out for yourself. But what does that mean for the cash per share? Well, basically, you're looking at um, billions of dollars, right? About $4 billion over the next 4.5 years that GameStop is going to generate in cash from interest and operational income. For over $4 billion of new cash generated. And then comes this April trigger date. How do we know that the convertibles are going to convert? Well, look, at the end of the year, 2029, they are sitting on $13.3 million, or sorry, billion dollars of cash, or $29.90 per share worth of cash. And then they still have 3 months to go until that 1.5 billion needs to convert. Look at that, 29.85. And we're looking at a base case, right? A very conservative case that, yeah, before they even get to that conversion date, they will have more than $29.85 worth of just cash alone. So that's assuming they have a PE of 0, right? No enterprise value whatsoever, which of course, as they stack year after year of increasing income from operations, they will receive an enterprise value reflective of their fundamental value. But what happens from a dilution perspective? Well, you see after that April trigger date, their cash floor continues to rise because if they dilute, they get to keep all of that money. But what also happens is their share count grows by that 50.24 million shares of dilution. So then their cash floor would decrease to $27 per share worth of cash because the share count is increasing, right? The market cap is still growing, but the share count is increasing. And if you didn't value that dilution in advance, you waited for it to come, well, then you would drop in about a $2 per share amount or $2.50 per share amount of cash after that trigger date. Roll forward another couple years, 2.5 years, and you are at that June conversion price, which again, after that next dilution, end of year 2031, you're looking at a $30.50 cash per share, right? $15 billion of cash the GameStop has. And what is the conversion price for the second convertible? $28.91. So again, even after that first tranche of dilution, you are above the conversion price for the next convertible, which means that in all likelihood, in June 2032, they will dilute that 2.7 billion, or in other words, 93 million more shares created. So their market cap, right, of just cash value continues to go up because they don't pay it back in debt. They keep the debt. The debt turns into dilution, right? The debt goes away, but then the dilution hits. So then again, the cash per share drops after that to 26.36. And then again, keeps marching on from there as they continue to generate more cash. This is what happens to the cash floor year by year if they dilute. Okay, if they dilute, guess what? They got to have the cash now, but they didn't have to dilute until 5 and 7 years from now. So at the time of dilution, they will have made an additional $4.3 billion in cash before the first dilution even happens. They will have made 4.3 billion before they have to hypothetically, pay back that 1.5 billion or before that dilution happens, right? And then again, another $2 billion generated before that 2.7 billion is then diluted. hopefully you're tracking. Here's the cash value that they have. Here's the share count. Here's the corresponding cash per share that happens. Now, what if they pay back the money in debt? What happens then? Well, the share count stays the same all the way through, right? But what happens in April is boom, your cash goes down because in April you pay back that 1.5 billion that you owe. And then again in June, you pay back that next 2.7 billion that you owe, right? 2.7 billion, 1.5 billion. So your share count stays the same, but your cash floor, your market cap represented by cash, is then written off. 1.5 is written off in April, 2.7 is written off in June. Some people want to treat the current cash floor as if you, some people want to write off all of that 4.2 billion right now, right? They want to pull forward the debt that GameStop would owe, but they don't want to factor in the cash that GameStop is going to generate over that period of time. So that's why I reflect their cash floor by the actual cash they have and the actual shares that they have. And then if you want to pull forward this dilution or this debt payoff, well, then you also pull forward the income and the interest that happens in that interim, right? So if you're going to say, well, what about the 4.2? Well, again, what about the 4 billion that's raised before that 1.5 is due, right? And then what about the almost 2 billion, right? The 1.7 billion that's raised before the 2.7 is due, right? 4.1 billion in cash plus another 1.7 billion in cash. 5.8 billion in cash raised from interest and income from operations before that 4.2 is due. 5.8 billion greater than sign 4.2 billion, right? So it if you want to pull forward the debt, then you also pull forward the income. And that doesn't work in the bear's favor, right? Because the income is 5.8 billion over that same period of time. So again, you could argue, right, the income from operations, oh, you don't think it's going to stay at 500, you think it's going to go to 450? Okay, great. $450 million of income. So that's, you net out 50 million over 6 years. And what have you accomplished? You've taken that 5.8 number down to a 5.5 number, which is still $1.3 billion more than the 4.2. Are you tracking with me? So the cash floor is the cash. If you want to net out the debt, then net out the cash that you're going to generate over that time period as well. If you want to wait until the time actually happens, then this is what happens. Again, your cash goes down, and as a result, your cash per share goes down, right? So the cash per share goes down in the dilution scenario because you diluted, even though your cash is still increasing. In the scenario that you pay back the money and as if it's debt, again, the cash per share goes down because you don't have as much cash. But still, the cash per share at any point in the future is higher than the current cash floor, right? There's no event, whether debt or dilution, if you break down year by year the cash generated from this business, there is no point where the cash floor is lower than it is right now. That is why I call this the cash floor. It is it's the lowest point of cash value over share count. right? It does not get lower at any point. Okay? So, hopefully this is making sense so far. What does this mean as far as GameStop's valuation as a company? Check this out, guys. So right now, GameStop is trading at $21.63 per share. When you net out the cash floor, that means they have a current enterprise value of $1.01 per share. You multiply that by the share count, 447 million shares, and you're looking at an enterprise value of $450 million for a company that in the forward 12 months will make $900 million of income. So you have a forward PE of 0.49, a 0.49 PE. And even if you wanted to take the trailing numbers, right? You want to take the trailing net income numbers, even though Power Packs didn't even exist for any of these 4 quarters, even though the Switch 2 wasn't out for 3 of these 4 quarters, even if you wanted to use the trailing numbers, you're still at a PE of a 1.24 for a company that's growing at over 150% year over year in their most important line item as a retailer, which is their collectibles division, and growing total top line at over 20% year over year. A trailing PE of 1.25, a forward PE of zero point 0.5. That is insane as far as thinking about the valuation of the company. Basically, right? Basically, that means that if you bought GameStop right now at 21.64 a share, that within 6 months, right, within half a year, you will have made enough, you will have made up the difference in cash, right? Like the actual cash per share 6 months from now, when they report Q4 earnings, will be $1.20 higher than its current cash per share. And you're only paying $1.02 for the whole business. So you can buy the business right now and receive in cash the full amount that you paid for the business in less than 6 months. That's how low GameStop is valued right now. And whether you talk about GameStop's going to dilute, or whether you talk about GameStop's going to pay back the convertibles in debt, again, if you want to pull forward those debt events or you want to pull forward those dilution events, then pull forward the impact of the cash that's generated over that time as well. And the present value of this cash generation exceeds the present cost of the dilution, and it exceeds the present cost of the debt. What happens to the cash per share floor in either scenario, whether they dilute or whether they pay it back? Look, in dilution, their cash goes to a 27.29 per share in the first tranche, and then a $26 per share in the second tranche. That's if they dilute. If they pay it back in cash, look, $27 a share and 25.43 a share. Right? It's like a 50 cent, it's a 29-cent difference 5 years from now. And then it's less than $1 per share difference 7 years from now. So whether you think they will pay it back in debt or not, whether you think they will dilute or not, we're talking about an impact as far as the floor, right? The cash floor of the company. We're talking about an impact that's less than $1 per share worth, that's also 7 years away. A less than $1, right? We're talking about less than $400 million worth of a difference that is 7 years away for a company that is on pace to make $900 million a year right now. Do you understand how insane it would be to get tripped up over these events? That no matter what way you account for them, is more than made up for by the cash generated by the business in the interim. Then the only question is, again, how do you value the company? What type of PE do you give the company in light of these plausible scenarios? And y'all know I think that the value right now is pretty attractive, given that even in the worst case scenario, and even if you fully price dilution today, there's still almost 100% upside. You know, I can't imagine fairly valuing this business less than $25 million in total enterprise value, asset management business plus retail business. I can't even imagine it. Amazing. Amazing value. Hopefully you learned something in this video. If you did, or if you didn't, we'll love a like, we'll love a comment, love a subscription if I've earned it from you yet. If you have any questions, you want to continue the conversation, feel free to comment in the video. That is all I got for y'all today. I will see you in the next one.